Howdy, Jacob here. Today we're looking at MPLX. It's the oil, gas, and consumable fuels industry. Roughly $37 billion market cap, $56 billion enterprise value. A lot of net debt here. Crazy appearing growth with the company being under 500 million in revenue 2013 and then over 10 billion in 2022. That's interesting to see. 9% dividend yield. Let's look at some of this debt here. 18 billion in long-term debt, relatively flat for the last 5 years. That 18 billion 5-year average free cash flow is maybe 3 billion. So 3 billion average on 18 billion long-term debt over 6 years of their 5-year average free cash flow. A little bit more than what you'd want to see. And it doesn't look like they've been historically thinking about buying back a lot of that, buying down a lot of that debt. Doesn't look like they have much cash on hand, if really anything. $238 million, so not a lot there. Looks like a lot of the money they do make, they pay out through their dividend, and they'll go into debt. It looks like to fund it if they don't have enough cash flow, which is not something you want to see, and you don't want to see that too often. Looks like they've been buying back a little bit of shares the last couple of years as well with some of their excess free cash flow. I think I'm ready to start making some assumptions here. I think first things first, I'll probably cut the dividend in half because although in the last 2 years that's a 60% payout is pretty reasonable. If you do a 5-year average, you're looking at about 3 billion, and that's 100% of it. So if I bring this down to about a little over 1.5 billion dollar payout, aggregate payout, that's sounds pretty reasonable to me. And then some of the other assumptions on price appreciation, I'll say, I mean, there's been a lot of growth recently, but I just have to. My initial assumption is that growth is due to um, oil and gas just being relatively pricier um, recently. So I might assume 0% growth, 10 on the P, and price to free cash flow. And that's just because I think it's going to decrease a bit maybe over the next couple of years, but then go back to essentially what it's at right now over the next 7 years. I think that's a reasonable assumption. I think margins have also been a lot higher, so I'm going to maybe lower those down a little bit. Share change, let's assume nothing. So I'm just not super confident in the assumptions, but I think this is definitely a company that I will keep on looking at. Definitely want to do more research on the company as it gets closer. Obviously, right now we're saying it needs to fall 55% to get us a 15% return. But even if they cut this dividend in half, you're looking at 4.6% dividend yield. To me, I would just want the company to start focusing on some of the right things with their excess free cash flow and not just pay out a bunch and then the years that they can't afford it, keep the dividend the same and then go into debt to fund um, the the dividend. So it's more so just wanting the company to do some of the right things before even really investing in it. But I think I'm comfortable with the assumptions we had, and I'm comfortable just waiting a bit of time before it falls quite a bit to do more research. All right. Hope everyone has a good rest of the day. Thank you.